Before we begin, please remember that I am not a licensed financial advisor, mortgage broker, or real estate professional. The information provided in this video is for educational and informational purposes only and should not be considered financial, legal, or tax advice. A mortgage is a significant financial commitment. Always consult with a qualified and licensed professional who can assess your individual financial situation before making any decisions. This presentation is designed to empower your conversations with those professionals, not to replace them. The single biggest financial mistake most Americans will ever make isn't buying the wrong stock or leasing a car they can't afford. It's not even buying the wrong house. The biggest, most expensive mistake you can make is getting the wrong mortgage. It's a quiet mistake. It doesn't feel like a mistake when you're signing the papers. You're excited. You're getting the keys to your dream home. The lender is smiling, your realtor is happy, and you're handed a glass of cheap champagne. But that one mistake, made in a moment of excitement and confusion, can silently drain tens, even hundreds of thousands of dollars from your pocket over the next 30 years. It's the ghost in your financial machine, a hidden tax on your future, and most people don't even realize they're paying it. You've done the hard part, right? You saved for the down payment, you polished your credit score until it shined, you spent countless weekends dragging yourself through open houses, smelling the freshly baked cookies meant to distract you. You finally found it. The one. The house with the perfect backyard for a dog. The kitchen that makes you want to actually learn how to cook. The neighborhood that feels like home. And now you're thrown into the real Hunger Games. Shopping for a mortgage. Suddenly you're drowning in an alphabet soup of acronyms. APR, LTV, DTI, PMI, PITI. It feels like you're trying to read a secret code. Lenders are throwing numbers at you. Closing costs, origination fees, discount points, prepayment penalties. It's a full-on assault of financial jargon designed to do one thing: confuse you. It's designed to make you feel overwhelmed, to make you feel like you're not smart enough to understand, so you'll just nod your head, smile, and sign wherever they tell you to sign. They want you to focus on just one thing: the monthly payment. They'll say, "Look, we can get your payment down to just $2,000 a month." And you think, "Great, I can afford that." But what you don't know is how they got you to that number. Did they extend your loan term? Did they sell you an adjustable rate mortgage that's going to explode in 5 years? Did they pack the loan with thousands of dollars in junk fees that you're now financing for the next 3 decades? This process is intentionally intimidating. You're making the largest purchase of your life, and you feel like you're at a massive disadvantage. It's like playing a chess match against a grandmaster, but you were only taught the rules 5 minutes ago. The person on the other side of the desk does this 10 times a day. You might do this 3 times in your entire life. Who do you think has the upper hand? But what if you could flip the script? What if you could walk into any bank or mortgage broker's office, sit down, and in less than 15 minutes, take complete control of the conversation? What if you had a set of questions so simple yet so powerful that they would instantly cut through all the noise, all the sales tactics, and expose the absolute truth about the loan they're offering you? What if you could know with total certainty whether you're getting a great deal or being taken for a ride? That is exactly why you are here. That is the promise of this video. We are going to arm you with 5 smart questions that will transform you from a confused homebuyer into a confident, empowered mortgage shopper. These aren't your typical generic questions like, "What's the interest rate?" Everyone asks that. That's surface level. The interest rate is the bait. We're going to teach you how to see the whole trap. These 5 questions are your secret weapon. They are designed to peel back the layers of complexity and force a level of transparency that most lenders are not used to providing. Asking these questions will instantly signal to them that you are not an easy target. It shows them you've done your homework, that you understand the game, and that you will not be pushed around or confused by fancy terminology. The difference between asking these questions and not asking them is not small. We're not talking about saving a few $100s. We are talking about life-changing money. The kind of money that could fund your retirement, pay for your kids' college education, or allow you to pay off your house 10 years early. A simple 0.25% difference on a $400,000 loan, for example, that's over $25,000 in extra interest payments. 25 grand. Gone. Poof. All because you didn't know the right questions to ask. Getting the wrong loan type could cost you over $100,000 if interest rates rise down the road. Hidden fees at closing can easily add $5,000 to $10,000 to your bill right at the start. This isn't a game. This is your financial future. So, if you're about to buy a home or even just thinking about it, this is the most important video you will watch. Forget the house hunting shows for a minute. Finding the house is the fun part. Securing the right financing is the part that builds your wealth. By the end of this presentation, you will have a simple, repeatable framework you can use with every single lender you talk to. You will feel a sense of clarity and confidence that you thought was impossible. You will be able to compare loan offers like a pro, apples to apples, and identify the superior deal in minutes. No more confusion, no more anxiety, no more wondering if you're getting ripped off. You will be in the driver's seat. Think of this video as your personal mortgage mentor, your guide through the financial maze. We're going to break it all down piece by piece. We're going to demystify the process and give you the exact language to use. These 5 questions will become your shield and your sword. They will protect you from predatory practices and allow you to cut to the heart of any mortgage offer. Ready to take control? Ready to save yourself thousands of dollars and a mountain of stress? Good. Let's get started. The first question we're going to cover is the foundation for everything else. It's a question that has almost nothing to do with numbers and everything to do with the person and the company you're about to entrust with the biggest financial decision of your life. It's so deceptively simple that almost no one thinks to ask it, but their answer will tell you almost everything you need to know before you even look at a single interest rate. The question is this: how exactly do you get paid? That's it. For simple words. But the answer is a skeleton key that unlocks their entire business model, their motivations, and whether they see you as a client to be served or a commission to be captured. See, when you ask this, you're not being rude. You're being smart. You're peeling back the curtain. A great loan officer, a true professional, will welcome this question. They'll be transparent. They'll say, "Great question. I work for a direct lender and I'm paid a set percentage of the loan amount, which is regulated by federal law, and doesn't change no matter what interest rate you get. My goal is to make you so happy with the process that you refer your friends to me." That's a good answer. But a bad loan officer? They'll squirm. They'll get defensive. They might say, "Oh, the bank takes care of all that." Or, "It's complicated." That's a red flag the size of Texas. It's complicated because they don't want you to understand it, because their compensation might be tied directly to the interest rate they sell you. This is a dirty little secret of the industry called yield spread premium. It's a fancy term for a kickback. In some cases, the higher the interest rate they convince you to take, the bigger the check they get from the wholesale lender. They're not on your team. They're playing against you. You need to understand there are 2 main types of people you'll talk to: a loan officer at a bank or direct lender, and a mortgage broker. A bank loan officer works for one institution. Think Wells Fargo or a local credit union. They can only offer you the products their bank has. A mortgage broker, on the other hand, is like an independent agent. They can shop your application around to dozens of different wholesale lenders to find the best deal. Neither one is inherently better than the other, but their compensation structures can be wildly different. By asking, "How do you get paid?" you force them to tell you where their allegiance lies. Is it with you, the borrower? Or is it with the lender who's paying them the biggest bonus for selling you a higher rate loan? This one question cuts through all the noise. It establishes that you're a savvy consumer, not an easy mark. It sets the tone for the entire relationship. And if they can't or won't give you a straight, confident answer, you thank them for their time, you walk away, and you never look back. Because if they aren't transparent about their own paycheck, how can you possibly trust them with yours for the next 30 years? Okay, so you've asked the first question. You've found someone you feel you can trust. They've been upfront about their compensation, and you feel confident they're on your side. They run your numbers, look at your credit, and say, "Congratulations, you're pre-approved." A few days later, an official-looking document lands in your inbox. It's called the loan estimate. It's a 3-page, legally mandated form, and it is designed, in theory, to make comparing loan offers easy. In reality, for most people, it looks like it was written in a foreign language. It's a dense wall of numbers, boxes, and acronyms. And this is where the second smart question comes in. It's your shield against hidden fees and financial sleight of hand. You get your loan officer on the phone, you pull up that document, and you ask, "Can you walk me through every single number on this loan estimate, line by line, and explain it to me like I'm 5? This question does 2 brilliant things. First, it completely disarms the situation. By saying, "Explain it like I'm 5, you're not admitting you're ignorant, you're demanding absolute clarity. You're giving them permission to drop the industry jargon and speak in plain English. There's no more hiding behind terms like origination charges, underwriting fees, or escrow in pounds. They have to break it down. What is an underwriting fee? It's the fee the lender charges to have a person, the underwriter, verify all your documents and officially approve your loan. Why is it $700? Is that a flat fee or a percentage? Is it negotiable? Suddenly, you're having a real conversation about where your money is going. The second and more important thing this question does is it forces a full accounting. It puts a spotlight on every single fee, big and small. Most people just look at the big numbers, the interest rate and the monthly payment. They gloss over Section B, the long list of services you cannot shop for. This is often where lenders pad their profits with what are politely called junk fees. I'm talking about things like an application fee. You're already paying an origination fee, why is there a separate fee just to apply? Or a processing fee and an underwriting fee. Aren't those part of the same process? I once saw a $400 document prep fee on a client's estimate. When we asked what that was for, the loan officer admitted it was the fee for him to click print on the final documents. We had that removed in about 30 seconds. That's a $400 print button. That's what you're looking for. When you ask them to go line by line, they know they can't hide anything. A great loan officer will see this as an opportunity to build trust and educate you. They'll patiently explain that title insurance protects you from claims against your property's history, that the recording fee is what the county charges to officially log the sale, and that your escrows are just a savings account for your future property taxes and homeowner's insurance. A bad loan officer will get frustrated. They'll rush. They'll say things like, "Oh, that's just a standard fee," or "Don't worry about that part." That's when you push back. "I do need to worry about it. It's my money. Please explain what this funding fee is for." Your insistence on understanding every line item signals that you are meticulous. You're not going to be rushed or confused into paying for things you don't need. This single question transforms the loan estimate from an intimidating legal document into a simple price tag. It's the difference between walking into a fancy restaurant where the menu has no prices and going to a diner where you know exactly what your burger, fries, and shake are going to cost you. By demanding this level of clarity up front, you're not just saving a few $100s on junk fees. You're preventing thousands of dollars in potential surprises down the road. You're taking control of the process. So now you've vetted the person and you've scrutinized the paperwork. You know how they're paid and you know exactly what they're charging you for. You're feeling good. You're feeling powerful. You've dodged the two biggest bullets that sink most homebuyers. But the most dangerous part of the journey is still ahead. Because there's a third party involved in this transaction, someone you'll never meet, who holds the power to kill your deal in the 11th hour and potentially cost you thousands of dollars of your own money. And the next question is the only thing that prepares you for when they strike. This person is the underwriter. In the world of mortgages, the underwriter is the final boss. They are the judge, jury, and all too often the executioner of your home loan application. They don't know you. They don't care about your dream house with the big backyard for the dog. Their job and their only job is to look at your file, a stack of papers that represents your entire financial life, and find reasons to say no. They are the risk department. They are the gatekeeper standing between you and the bank's vault. Your loan officer's job is to sell you the loan. The underwriter's job is to protect the bank from you. And because of this dynamic, the relationship between your loan officer and that underwriter is one of the single most important, yet completely invisible factors in your home buying journey. A good relationship means smooth sailing. A bad or non-existent relationship means your dream can turn into a nightmare overnight. Which brings us to the second smart question you must ask every single lender you speak with. And that question is, can you describe your underwriting process, and is your underwriting team in-house? Now, that might sound like technical industry jargon. It might sound like a detail that doesn't matter. I am telling you, the answer to this question separates the lenders who will fight for you from the ones who will abandon you at the first sign of trouble. It's the difference between a partner and a call center. Let's break down why. When you ask, is your underwriting team in-house? You are asking a very simple question. When my file gets complicated, and trust me, almost every file gets complicated, can you walk down the hall and talk to the person making the decision? If the answer is yes, you have a massive advantage. An in-house underwriter is part of the same team. They know the loan officer. They sit in the same meetings. They understand the local market. When a problem comes up, your loan officer can have a real human conversation with them. They can explain the nuance of your situation. They can say, "Hey, I know this part of the file looks a little weird, but here's the story. Here's the context." They can work together to find a common sense solution. It's a collaboration. Now, what if the answer is no? What if they say, well, we use a centralized national underwriting center, or our files are sent to our corporate processing hub? This is corporate speak for, I, your loan officer, have absolutely no control. This is the factory model of mortgage lending. Your file becomes a number in a queue sent to a random underwriter who could be thousands of miles away, working in a giant soul-crushing cubicle farm. They don't know your loan officer. They don't know your state. They don't know you. They have a checklist, a rigid set of rules, and zero incentive to apply common sense. Communication is not a conversation. It's a series of cryptic messages sent through a slow, clunky online portal. Getting a response can take 24 to 48 hours. And when you're 3 days from closing, 48 hours is an eternity. It's the difference between closing on time and losing the house. Let me paint you a picture of what this looks like in the real world. Meet Mark and Sarah. They're first-time homebuyers, and they did what most people do. They shopped online and found a lender offering an interest rate that was just a tiny bit lower than everyone else's. Seemed like a no-brainer. The process started smoothly. They submitted their documents, got their pre-approval, found a house, and went under contract. They paid $500 for an appraisal. They paid another $400 for a home inspection. They were so excited, they gave their 30-day notice to their landlord. Their closing date was set for a Friday. On the Tuesday before closing, 3 days out, they get a frantic call from their loan officer. The underwriter, this faceless person in another state they've never heard of, had a last-minute question about Mark's income. Mark was self-employed, and while his income was stable, the way he filed his taxes one year was slightly different from the next. It was a minor issue, easily explainable with a quick letter from his accountant. But the loan officer couldn't just talk to the underwriter. He had to submit a message into the black hole of the corporate portal. Tuesday passes. No response. Wednesday morning, the loan officer is sending frantic follow-up messages. The seller's agent is calling, asking if they're going to close on time. Mark and Sarah are panicking. Wednesday afternoon, a message comes back from the underwriter. Need updated profit and loss statement for the current quarter, signed and dated. Mark scrambles, gets it from his accountant, and they upload it immediately. Thursday morning, the day before closing. Silence. The loan officer is calling a corporate hotline, getting put on hold, being told the file is in review. He has no direct number, no name, no way to escalate. He is powerless. Thursday afternoon, they get the devastating news. The underwriter isn't satisfied. They want 2 years of audited financial statements, something that would take weeks and thousands of dollars to produce. The deal is dead. Their rate lock expires. The seller, fed up and scared, cancels the contract and keeps their earnest money deposit. Mark and Sarah are out their appraisal money, their inspection money, their deposit, and now they're homeless in 3 weeks because they gave notice at their apartment. All because their loan officer couldn't have a 5-minute conversation with the person holding their future in their hands. Now let's look at another couple, David and Jessica. They chose a local lender who, when asked, proudly said, "Oh yeah, our entire team is right here. Our underwriters are just in the next room." Their rate was maybe 0.1% higher than the online factory lender, but they liked their loan officer and felt comfortable. They go under contract. A week before closing, a similar issue arises. Jessica recently received a promotion and a raise, but the underwriter's automated system flagged it as a job change, which can be a red flag. Instead of a crisis, this is what happened. The underwriter, Susan, saw the flag, got up from her desk, walked 10 feet to the loan officer's office and said, "Hey, what's the deal with Jessica's income?" The loan officer pulled up the file and said, "Oh, it's a promotion. She's been with the same company for 5 years. Here's the offer letter from her boss showing the new title and salary." Susan looked at it for 30 seconds and said, "Ah, got it. Makes sense. No problem." And that was it. The problem was identified, discussed, and solved in less than 2 minutes. There were no panicked phone calls, no sleepless nights, no delays. David and Jessica closed on time, without a single hitch, and moved into their new home. The difference between these two stories isn't the borrowers. It isn't the houses. It's the lender's process. It's the structure. It's the answer to that one simple question. Is your team in-house? One process is built for volume and profit, treating you like a number on an assembly line. The other is built for service and success, treating you like a human being. The cheap online rate that Mark and Sarah chased ended up costing them thousands of dollars and their dream home. The slightly higher rate that David and Jessica accepted bought them peace of mind and, most importantly, a successful closing. When you're shopping for a mortgage, you are not just shopping for money. You are hiring a team to guide you through one of the most complex and stressful transactions of your life. You need to know who is on that team. So, when you call a lender, ask the question. Listen carefully to the answer. If they're proud of their process, they'll be excited to tell you about it. They'll tell you about their underwriters, their processors, their closers, and how they all work together. You'll hear confidence in their voice. But if they hesitate, if they give you a vague, corporate answer, if they try to dismiss the question as unimportant, run and do not look back. Because they are telling you without saying the words that when things go wrong, you will be on your own. You've now protected your deal from the number one silent killer. A dysfunctional, invisible underwriting process. You've learned to prioritize certainty over a deceptively low rate. But what about the money you might be leaving on the table? What about the costs that are actually negotiable? The next question we're going to cover uncovers the hidden fees that lenders pray you never ask about. It's a simple 5-word question that can save you hundreds, even thousands of dollars, by shining a light on the part of their price quote they hope you'll ignore. And that question is this: what are your total lender fees? Not the interest rate, not the monthly payment, not the APR, the lender fees. It sounds almost too simple, doesn't it? But behind those 5 words is a power that completely shifts the negotiation in your favor. You see, the mortgage industry has perfected a kind of financial magic trick. They want you to stare at one hand, the shiny low interest rate, while the other hand is quietly emptying your pockets through a dozen different fees with confusing names. This is their game. They know the average homebuyer is rate obsessed. They'll dangle a 6.25% in front of you when everyone else is offering 6.5%. Knowing your brain will lock onto that lower number like a heat-seeking missile. Feels like a win. Feels like you're getting a deal. But the interest rate is only one half of the equation. The other half, the one they bank on you ignoring, is the price you paid to get that rate. Think of it like buying a plane ticket. You find a flight for $99. Amazing! You click buy, and suddenly you're hit with a seat selection fee, a carry-on bag fee, a checked bag fee, a convenience fee for booking online, and a fee for printing your own boarding pass. That $99 flight is now $220. The mortgage world operates on the exact same principle, but with thousands, not hundreds of dollars at stake. The lender fees are all their add-ons. They go by many names, and they are designed to sound official and non-negotiable. You'll see things like an origination fee, a processing fee, an underwriting fee, an application fee, an admin fee, a document preparation fee, a funding fee. It's a blizzard of jargon. Some of these are legitimate costs of doing business, but many of them are what insiders call junk fees. Pure profit centers padded into your loan. The lender is essentially charging you for the privilege of them doing their own job. They're charging you a fee for processing the paperwork, and then another fee for the underwriter to look at that paperwork, and then another fee for an administrator to file that paperwork. It's death by 1,000 cuts. So let's put this into a real-world scenario. Let's say you're shopping for a $400,000 loan. You get 2 quotes. Lender A offers you a rate of 6.625%. Lender B comes in with a dazzlingly low rate of 6.375%, a quarter of a percent lower. Your instinct, and the instinct of 99% of buyers, is to jump on Lender B's offer. It's a no-brainer, right? Lower rate means a lower monthly payment. You're ready to sign. But then you remember this video. You pause, take a breath, and you ask both lenders that simple question. Can you please walk me through your total lender fees on the loan estimate? And this is where the magic trick is revealed. Lender A, the one with the higher rate, comes back and says, certainly. Our total lender retained fees are $1,500. That's a flat fee that covers our processing and underwriting. We don't charge separate junk fees. It's clean. It's simple. Now it's Lender B's turn. The loan officer might hesitate for a second. They might try to redirect you back to the amazing rate. But you hold firm. I understand the rate is great. I just want to see the fees. So they pull up the quote and you start seeing the numbers. There's a 1% origination fee. On a $400,000 loan, that's $4,000 right there. Then there's a $750 processing fee, and a $995 underwriting fee, and a $250 admin fee. When you add it all up, Lender B, the one with the deal of a rate, is charging you $5,995 in fees. That's nearly $4,500 more than Lender A. Suddenly the deal doesn't look so good. That lower interest rate came with a massive front-loaded cost. Now let's do the math that lenders pray you never do. The lower rate from lender B saves you roughly $65 a month on your payment. That sounds nice, but you just paid an extra $4,500 at the closing table to get that savings. So, how long will it take for that $65 a month to pay you back for the extra $4,500 you spent up front? You take $4,500 and divide it by 65. The answer is 69 months. That's 5 years and 9 months. You would have to stay in that exact loan without refinancing for almost 6 years just to break even. But what do the statistics say? The average American homeowner refinances or moves every 5 to 7 years. You could very well sell the house or refinance your loan long before you ever actually start realizing the savings from that lower rate. In that scenario, you just gave lender B an extra $4,500 for absolutely no reason. You fell for the magic trick. This is why asking about lender fees is non-negotiable. It's the single most important variable you can control when shopping for a mortgage. Here's your exact action plan. When a lender gives you a quote, demand that they send it to you in the official format, called a loan estimate. It's a standardized 3-page document. Don't accept a worksheet, a summary, or a verbal quote. You want the official loan estimate. Once you have it, immediately turn to page 2. Look at the top left corner. You will see a box labeled A. Origination charges. This box is the lender's entire world. This is where they make their money. It will list their origination fee, their points, their application fees, their underwriting fees, everything they are personally charging you to do the loan. This number, the total in box A, is the only number that is 100% controlled by the lender. It is the only true apples-to-apples comparison you can make. The other costs on your loan estimate, things like appraisal fees, title insurance, government taxes, are third-party charges. A lender has very little control over them, and they'll be roughly the same no matter which lender you choose. So you can effectively ignore them for comparison purposes. Zero in on box A. When you have loan estimates from 3 different lenders, you put them side by side and you look at 2 things and 2 things only: the interest rate and the total of box A. That's it. That's the whole game. A lender offering a 6.5% rate with $1,000 in box A is almost always a better deal than a lender offering 6.25% with $5,000 in box A. Especially if you don't plan on living in the house for 30 years. You are looking for the best combination of rate and fees for your timeline. By asking what are your total lender fees, you force them to stop the shell game and show you the real price tag of their loan. You take back control. You turn their magic trick into simple, transparent math. But what happens when the lender has a good answer for those high fees? What if they say, oh, that $5,000 charge in box A isn't a junk fee. That's 4 discount points to permanently buy down your interest rate. Sounds legitimate. It sounds smart. Paying a little extra now to have a lower rate for the next 30 years? That must be a good investment, right? Well, sometimes it is. And sometimes it's an even more sophisticated trap, designed to get you to prepay interest that you will never see a benefit from. Distinguishing between the two is critical, and it requires asking another, even more specific question that forces the lender to prove with cold, hard numbers whether paying for points is a brilliant financial move or the single biggest mistake you can make. And that is exactly what we're going to break down next. So, you're sitting across from the loan officer or you're on the phone, and they've just presented you with 2 options. Option A has a 7% interest rate with 0 points. Option B has a 6.75% rate, but it'll cost you 1 discount point. 1% of the loan amount, paid upfront at closing. They'll often frame it as an investment. Pay a little now, save a lot later. And they're not wrong sometimes, but sometimes isn't good enough when we're talking about the biggest purchase of your life. You need certainty. You need a way to cut through the sales pitch and get to the mathematical truth. The question you need to ask is this: what is my exact break-even point on these discount points? And you don't just ask it. You wait for the answer and you watch them do the math. If they can't answer it instantly, that's a red flag. If they try to give you a vague, oh, you'll make it back in a few years, that's an even bigger red flag. You want a number, a precise number of months, because the break-even point is the single most important number in this entire decision. It is the tipping point. It's the moment in time where the money you paid up front is officially paid back to you through your monthly savings. Before you hit that point, you're in the red on your investment. After you hit that point, every single mortgage payment you make puts pure, cold, hard cash back in your pocket. Let's break it down with a real-world example so you can see just how powerful this is. Imagine you're getting a $400,000 mortgage. The lender offers you a 30-year fixed rate at 7%. Your monthly principal and interest payment would be about $2,661. But then they offer you the deal. Pay one discount point, which is 1% of the loan amount, so that's $4,000 cash you have to bring to closing, and they'll drop your rate to 6.75%. At 6.75%, your new monthly principal and interest payment is about $2,594. Okay, so you're saving money each month. How much? You just subtract the new payment from the old one. $2,661 minus $2,594 equals $67. You are saving $67 every single month. That sounds great, right? But you had to pay $4,000 up front to get that savings. This is where the break-even calculation comes in. It's simple division. You take the total cost of the points and divide it by your monthly savings. So for $1,000 divided by $67 per month equals 59.7. Let's call it 60 months. Your break-even point is 60 months, which is exactly 5 years. This number 5 years is your crystal ball. It tells you the future of your finances. It transforms the decision from a fuzzy guess into a simple binary choice. Here's what it means: if you are 100% certain that you will not sell your home, and you will not refinance your mortgage for at least the next 5 years, then buying that point is a smart financial move. For the first 5 years, you're just paying yourself back for that initial $4,000 investment. But in month 61, that $67 savings is pure profit. It's a guaranteed tax-free return on your investment. Over the remaining 25 years of the loan, that adds up to over $20,000 in savings. That's a brilliant move. But what if you're not sure? What if you're a young couple buying your first home, and you know there's a good chance you'll want a bigger place in 3 or 4 years when you start a family? If you sell that house in 4 years, that's 48 months. You will have paid $4,000 for the privilege of saving only $3,216. You will have literally lit $784 on fire. You paid the lender for a discount you didn't stick around long enough to fully use. You lost. The bank won. Think about the different types of buyers. There's the forever home buyer. They're moving to their dream house in a great school district, and they plan on staying there until they retire. For them, a 5, 6, or even 7-year break-even point could be a fantastic deal. It's a long-term play that will pay off handsomely. Then there's the starter home buyer, or the corporate relocation buyer. They know with a high degree of certainty that they will be moving within a few years. For this person, paying for points is almost always a terrible idea. They are virtually guaranteeing a financial loss. They should be doing the opposite, which we'll get to, maybe even taking a slightly higher interest rate in exchange for the lender giving them a credit to cover closing costs. And then there's the third, and perhaps most common type of buyer today, the strategic refinancer. This person believes, as many do, that interest rates are currently high and will likely come down in the next 18 to 36 months. Their plan isn't to sell the house, but to refinance the loan as soon as rates drop. This is a critical point that most people miss. Refinancing your mortgage is the same as selling your house from the perspective of your break-even point. When you refinance, you are paying off your old loan and starting a brand new one. That clock on your break-even point, it gets reset to 0. So if you pay $4,000 for points today, and then in 2 years you refinance to a lower rate, you've lost. You only enjoyed 24 months of that $67 savings, meaning you only recouped about $1,600 of your $4,000 investment. You threw away almost $2,400. This is why you must be brutally honest with yourself about your future plans. A loan officer has no idea what your 5-year plan is. Their job is to sell you a loan product. And from their perspective, getting you to pay points is a massive win for them. They get that $4,000 commission-generating revenue for the bank on day one. It's guaranteed income for them. Whether you actually benefit from it over the long run is your responsibility, not theirs. By asking, "What is my break-even point?" you turn the tables. You force the conversation to be about your timeline, your financial future. You're no longer talking about their product. You're talking about your life. And you can even play with the numbers. You can ask, "Okay, a 5-year break-even is a little long for me. What would it take to get that down to 3 years? How many points would that cost, and what would the rate be?" This shows the lender you're a sophisticated borrower. You're not just looking at the shiny interest rate. You're analyzing the total cost and the return on investment over time. This single question elevates you from a typical customer to a savvy negotiator. Now, mastering the break-even point on discount points is a massive step. You've just learned how to dissect the most common and expensive choice a lender will offer you. You've learned to look past the monthly payment and analyze the long-term value. But the interest rate and the points used to change it are only one part of the battlefield. Lenders are incredibly smart. If they can't make extra money off you with points, they will try to do it elsewhere. They will hide fees in plain sight, buried in a document filled with confusing line items and industry jargon. This document is called the loan estimate, and it is a minefield of charges, from origination fees and underwriting fees to processing fees and courier fees. Some are legitimate, many are not. They're what people in the industry call junk fees, pure profit centers for the lender, disguised as necessary costs. Simply asking about your interest rate isn't enough. You have to go deeper. You have to ask a question that forces the lender to pull back the curtain on every single dollar they plan on charging you. A question that separates the real costs of getting a mortgage from the inflated fees they're hoping you won't notice. And that is the next weapon we are adding to your arsenal. The question you need to ask is not, "What are your fees?" That's too simple. They have a canned answer for that. You need to be more precise, more demanding. You need to ask, "Can you please provide me with a line item breakdown of all closing costs, including every lender fee, third-party fee, and prepaid item on an official loan estimate form?" Let's break down why this specific phrasing is so powerful. First, you're not just asking for a number. You're demanding a document, a legal, standardized document called the loan estimate. This isn't some marketing flyer or a number scribbled on a napkin. By law, once you submit a basic application, a lender must provide you with this form within 3 business days. It's designed by the Consumer Financial Protection Bureau for one reason: to let you compare apples to apples. It forces every lender to show their cards in the exact same format. Second, you're using specific language, line item breakdown, lender fees, third-party fees, and prepaid items. This signals to the loan officer that you are not a typical, uninformed buyer. You know the game. You know that closing costs is a giant bucket where they can hide all sorts of ridiculous charges. You're telling them, "I want to see everything, every single line." This question changes the entire dynamic of your conversation. You go from being a customer asking for a price to an auditor demanding an accounting. And that's exactly where you want to be. Now, when you get this loan estimate, you're going to feel like you're looking at a tax form. It's dense. It's intimidating. That's by design. But we're going to demystify it right now. You only need to focus on a few key areas to spot the traps. First, look at page 2, section A. This is the big one. It's titled Origination Charges. Think of this as the lender's direct profit. This is what they are charging you personally for the service of creating your loan. You'll see a line for points. This is a percentage of the loan amount you might pay to lower your interest rate. We're going to dedicate a whole section to that later because it's a massive topic. But for now, look at the other fees in this box. You might see things like an application fee, a processing fee, an underwriting fee, or a funding fee. Here's the dirty secret. Many of these are just different names for the same thing. It's like going to a restaurant and the bill has a charge for your steak, a cooking fee, a plate usage fee, and a chef's salary fee. It's nonsense. A good, transparent lender will often roll all of their costs into one single clear origination fee. When you see a lender nickel-and-diming you with 4 or 5 different fees in section A, that is a giant red flag. They are trying to confuse you and pad their pockets, hoping you won't question $100 here and a few hundred there. But it all adds up. Challenge them. Ask, "What is this underwriting fee for specifically? That isn't covered by the origination fee." Watch them squirm. Next, look at section B, titled Services You Cannot Shop For. This is a tricky one. These are required services, like the appraisal of the home, a credit report fee, and flood certification. The lender chooses the provider and you just have to pay the bill. So what's the problem? The problem is markups. The actual cost for a credit report might be $60, but the lender might charge you $100. The appraisal might cost $500, but they might bill you for $650. While this is less common with reputable lenders, it happens. When you're comparing loan estimates from different lenders, if you see one lender charging significantly more for the exact same service in section B, you need to call them on it. Ask them, "Why is your appraisal fee $200 higher than lender X's for the same property?" You are forcing them to justify their costs. Now for the best part. Section C. Services you can shop for. This is where you can save serious money. This section includes things like title insurance, settlement agent fees, and pest inspection fees. The lender will give you a list of their preferred providers, and they'll put that provider's estimate on the loan estimate. But here's what you need to know. You do not have to use their guy. In fact, you shouldn't. Their preferred provider is often chosen for convenience and relationships, not because they are the cheapest. Take title insurance. This is a policy that protects you and the lender in case there are ownership disputes with the property down the road. Can cost thousands of dollars. By taking an hour to call 3 or 4 different title companies in your area, you could easily save $500, $1,000, even $1,500. The same goes for the settlement agent or closing attorney. Shop around. Get quotes. The lender is legally required to work with any reputable provider you choose. By simply exercising your right to shop for these services, you are taking back control and cutting out the fat. So, when you get that loan estimate, your mission is to go through it line by line. Circle every fee in Section A and ask yourself, does this feel like a legitimate charge or a junk fee? Compare the costs in Section B to other lenders, and make a plan to aggressively shop for every single service listed in Section C. This one question, this demand for a detailed loan estimate, is your single greatest tool for uncovering the true cost of a mortgage. It peels back the layers of complexity and exposes the raw numbers. And it does something even more important. It tells the lender that you are a serious, educated consumer who will not be pushed around. But getting this breakdown of fees is only half the battle, because there's a type of fee we haven't fully discussed yet. A fee that you willingly pay. A fee that lenders will present as an amazing opportunity. A way to save tens of thousands of dollars over the life of your loan. They're called discount points. And they are one of the most misunderstood and potentially misused elements in the entire mortgage industry. Paying them can be the smartest financial decision you ever make, or it can be the equivalent of setting a pile of cash on fire. And figuring out which one it is for you requires asking our third smart question. What is my break-even point on these discount points? This question is the kryptonite to a lazy sales pitch. It takes the vague, fuzzy concept of a lower rate and slams it down onto a hard, cold, real-world timeline. It forces the lender to stop talking about abstract percentages and start talking about months and years. Your months and your years. So what exactly is a break-even point? It's the precise moment in time when the total amount of money you've saved from your lower monthly payment exactly equals the upfront cash you paid for the discount points. Before that moment, you're technically in the red on that decision. After that moment, every single month, you are in the green. You are officially making a profit on your investment. Let's make this crystal clear with an example. Imagine you're getting a $400,000 mortgage. The lender presents you with 2 options. Option A, no points. Your interest rate is 7%. Your monthly principal and interest payment would be about $2,661. Option B, you pay 1 discount point. Remember, 1 point is 1% of the loan amount, so you pay $4,000 in cash at closing. In exchange, the lender drops your interest rate to 6.75%. Your new monthly principal and interest payment would be about $2,594. Now, a salesperson might just focus on that monthly payment. They'll say, look, you can save $67 every single month for the next 30 years. All it takes is a one-time payment of $4,000. And when you put it like that, it sounds tempting. Who doesn't want to save $67 a month? But the smart homebuyer, the one who's watching this video, asks the critical question. What is my break-even point? And here's how you or the lender would calculate it. First, you find the monthly savings. That's simple. It's the payment from option A minus the payment from option B. So, $2,661 minus $2,594 gives us a monthly savings of $67. Second, you take the total upfront cost of the points, which was $4,000. Finally, you divide the total cost by the monthly savings. So, for $1,000 divided by $67 per month equals 59.7. We'll call it 60 months. 60 months. That's your break-even point. In other words, you will have to make exactly 60 mortgage payments or 5 full years before you even start to see a single penny of actual savings from paying that $4,000 upfront. For the first 5 years of your mortgage, you are just paying yourself back for the points. The real benefit, the gravy, only starts in month 61. Suddenly, the decision isn't just about saving $67 a month. The decision is now a bet. You are betting $4,000 that you will keep that specific mortgage on that specific house for more than 5 years. And this is where you have to be brutally honest with yourself about your life. Are you a young couple in a starter home that you know you'll outgrow in 3 or 4 years when you have kids? If so, paying those points is like buying a 5-year gym membership on your way out of town. You're just giving away money. You'll sell the house, pay off the loan, and that $4,000 you paid for a lower rate will have been completely wasted. Are you in a job that might require you to relocate in the next few years? If there's a good chance you'll be moving before you hit that 5-year mark, paying points is a losing bet. But the biggest, most important factor in today's market is refinancing. Let's say interest rates are high when you buy, like they have been recently. A lot of people are buying homes with the full intention of refinancing as soon as market rates drop significantly. Refinancing means you are paying off your old loan entirely and replacing it with a brand new one. When you do that, the game is over. The clock resets. Any money you spent on discount points for that original loan is gone forever. If you paid $4,000 for points and then refinanced your mortgage 3 years later, you lost that bet. You spent $4,000 to save money over 5 years, but you only stuck around for 3. You never broke even. The bank, on the other hand, gladly pocketed your $4,000 as pure, upfront profit. This is why lenders love selling points. It's a guaranteed, non-refundable fee for them. They get their money on day one. Whether you sell, refinance, or pay the loan off early, they don't care. They already won. So when you ask, what is my break-even point? You're not just asking for a number. You are forcing a conversation about your own future. A good loan officer won't just give you the number. They'll ask you clarifying questions. Okay, the break-even is 5 years. How long do you realistically plan to be in this home? Are you thinking about refinancing if rates drop by 1%? If a lender seems annoyed by this question, or if they try to brush it off with a vague answer like, oh, it's a great deal, you'll save a ton in the long run, that is a massive red flag. They should be able to calculate this for you in less than a minute. It's basic math. Their refusal to engage with it suggests they're more interested in their commission than in your financial well-being. The ideal break-even point is different for everyone, but a general rule of thumb is that anything under 4 or 5 years can be a reasonable bet if you're very confident you'll be staying put. A break-even point of 7, 8, or even 10 years. That's a much riskier proposition. The average American homeowner stays in their home for about 10 years, but that's just an average. Life is unpredictable. A decade is a long time for nothing to change. Asking about the break-even point transforms you from a passive consumer into an active strategic investor. You're not just buying a house. You're making a calculated financial decision about cash flow and return on investment. You're weighing an upfront cost against future, unguaranteed savings. And by understanding that timeline, you can align your mortgage strategy with your actual life strategy. It's a simple question that reveals a world of complexity, and it puts you squarely in the driver's seat. Now, paying thousands of dollars for points is just one piece of the upfront cash puzzle. It's often the biggest optional fee, but it's surrounded by a dozen other mandatory fees that can add up to a staggering amount of money you need to bring to the closing table. These are the infamous closing costs, a murky collection of charges that can vary wildly from lender to lender. Understanding them is non-negotiable, which leads us directly to our fourth smart question. So, our fourth smart question is this. Can you provide me with an itemized breakdown of all closing costs on an official loan estimate? And can you clearly separate your lender fees from the third-party fees? This question is a surgical strike. It cuts through the vague promises and forces the lender to put everything in writing on a standardized, government-mandated form. The loan estimate is your best friend in this process, but most people don't know how to read it properly. It's like being handed the enemy's playbook, but it's written in a language you don't quite understand. Let's translate it. When you get this document, you're not just looking at the final number at the bottom. You're looking for 3 specific boxes, 3 battlegrounds where you can save serious money. The first is page 2, section A, origination charges. Think of this as the lender's direct paycheck. This is what they are charging you personally for the service of creating your loan. It includes things like an application fee and underwriting fee, and critically, any points you're paying to lower your interest rate. This box, section A, is the single most important number to compare between different lenders. Why? Because you're comparing apples to apples. If lender A is charging you $3,000 in section A for a 6.5% loan, and lender B is charging you $5,000 in section A for the exact same 6.5% loan, you have a very clear picture of who is more expensive. There's no ambiguity. This is their price tag. Asking a lender to explain every single line item in this section is not being difficult. It's being a smart consumer. You're asking them to justify their salary for the work they're doing for you. Now let's move to the next area, section B. Services you cannot shop for. This sounds intimidating, right? Cannot shop for. Feels like you're trapped. But this is a bit of a misnomer. While it's true that the lender chooses the providers for these services, things like the appraisal of the home, the credit report fee, a flood certification fee, it does not mean you can't compare the costs of these services between different lenders. Some lenders have in-house appraisal management companies or mark up the cost of the credit report. Others simply pass along the direct cost. So, while you can't pick your own appraiser, you can pick a lender who charges a more reasonable $450 for the appraisal fee instead of one who charges $600. The power is still in your hands, but it's exercised by comparing the loan estimates. You're looking for the lender with the most reasonable and transparent pass-through costs. And that brings us to the real gold mine. Section C, services you can shop for. This is where the game truly changes. This section includes some of the most expensive closing costs, like title insurance, settlement agent fees, and pest inspections. The lender is required by law to give you a list of providers for these services, but here's the secret they don't shout from the rooftops. You almost never have to use their list. Their preferred title company might just be the one that sends them the best gift baskets during the holidays. It is your absolute right to shop around for these services on your own. Think about it. Would you buy a plane ticket without checking different airlines? Would you buy a car without looking at different dealerships? Of course not. So why would you accept the first quote for title insurance, a service that can cost well over $1,000, without seeing if you can get a better deal? The Consumer Financial Protection Bureau, the government watchdog for this stuff, found that consumers who actively shop for settlement services can save, on average, $500. I know people who have saved over $1,000 with just 3 phone calls. When you ask a lender to break down these costs, you're sending a clear message. I am not an easy target. I am an informed buyer, and I will be verifying these costs. This often pressures them to be more competitive with their own estimates from the very beginning. So let's put this all together. You're not just asking for a list of fees. You are demanding the loan estimate form. You are taking that form and you are immediately looking at page 2. You circle section A to compare the lender's direct profit. You scrutinize section B to see if they're padding the third-party costs they control. And you put a giant star next to section C as your personal to-do list for saving money. By asking this one question, you transform from a passive loan applicant into an active, empowered financial detective. You're not just asking how much does it cost. You're asking what am I paying for, why am I paying for it, and where can I do better? It forces transparency and exposes the so-called junk fees that lenders sometimes use to inflate their profits. It's the difference between paying the sticker price and paying the real price. Okay, so you've done it. You've used these first 4 questions to master the numbers. You've dissected the interest rate, you understand the APR, you've clarified the points, and you've demanded a full accounting of the closing costs. You have 2 loan estimates in front of you from 2 different lenders, and one looks like a clear winner. It has a great rate, lower fees, it's perfect. You're ready to move forward, confident you've secured the best possible deal. But hold on, because the best deal on paper means absolutely nothing if it vanishes into thin air a week before you get the keys to your new home. What happens if that fantastic 6.5% interest rate you were promised suddenly becomes 6.875% right before closing? What recourse do you have? All that hard work, all that negotiation could be wiped out in a single email. This is not a scare tactic. This happens every single day. And it happens because homebuyers fail to ask our 5th and final question, arguably the most important question for protecting your wallet and your sanity in the final, most stressful weeks of the home buying process. It's the question that locks in your victory. It's the question that turns the tables on the entire process, shifting power from the lender to you. Let's go back to our couple, Mark and Sarah, who you'll remember just found their dream home. They shopped around, they got pre-approved, and they locked in what they thought was a fantastic interest rate with lender a quarter point lower than anyone else. They were ecstatic. They celebrated. They started picking out paint colors and measuring for new furniture. They submitted all their documents, the appraisal came back clean, and they were in the home stretch just 3 days before closing. Then the email arrived. It was the closing disclosure. This is the final legally required document that outlines the exact terms and costs of your loan. Mark opened the PDF and his heart sank. He scrolled down to the cash to close number. It was $7,000 higher than they had budgeted for. $7,000. Panic set in. Where did this number come from? Their down payment was the same. The loan amount was the same. The interest rate was the same. But the total fees, the fees were astronomical. He called their loan officer frantic. The loan officer was calm, almost dismissive. Oh, those are just the standard closing costs. Origination fees, processing, underwriting, title services, settlement fees. It's all standard. But it wasn't standard. It was a classic bait and switch. Lender A had lured them in with an artificially low interest rate, knowing full well they were going to slam them with exorbitant, non-negotiable fees at the last possible second. With just 3 days until closing, with their moving truck already booked and their apartment lease ending, what choice did they have? They had to drain their emergency fund, borrow from a family member, and walk into that closing feeling defeated, taken advantage of, and starting their homeownership journey on the back foot. Their victory was stolen at the finish line. This happens every single day. And it happens because homebuyers fail to ask our fifth and final question, which is this. Can you please provide a formal loan estimate and walk me through every single line item in section A, B, and C, explaining which fees are yours, which are third party, and which ones I can shop for myself to find a better price? This question isn't just a question. It's a demand for total transparency. It forces the lender to lay all their cards on the table right at the beginning, not 3 days before closing. The document you're asking for, the loan estimate, is a standardized 3-page form created by the government. Its entire purpose is to help you compare apples to apples. Any lender who hesitates, gets defensive, or says we'll get to that later, when you ask this question, is waving a giant red flag. Run. When you get this document, you are going to become a forensic accountant. You're not just looking at the interest rate on page 1. You're going straight to page 2, to the section called Closing Cost Details. This is where the money is hidden. This section is broken down into several boxes, but we're going to focus on the first 3: Box A, Box B, and Box C. Box A is origination charges. This is the lender's pure profit. This is what you are paying them directly for the service of creating your loan. You'll see line items like an origination fee, an application fee, a processing fee, or an underwriting fee. Sometimes they'll lump it all together as 1% of the loan, often called points. 1 point is 1% of the loan amount. These fees are set by the lender and are 100% negotiable. When you compare loan estimates from lender A and lender B, this is the first box you should look at. A lender might offer a slightly lower interest rate, but if their origination charges in Box A are $2,000 higher, are you really saving any money? No, you're just paying them in a different way. Next, you move to Box B. Services you cannot shop for. This is a critical section. These are fees for essential third-party services, but the lender chooses the provider. You have no say. This includes the appraisal fee, the credit report fee, a flood determination fee, and others. Because you can't shop for these, you need to scrutinize them. Is one lender charging you $750 for an appraisal while another is charging $550? That's a $200 difference. Why? Are they using a more expensive appraisal management company? Is there an upcharge? You need to ask. High fees in this section can be a sign of a lender who has cozy relationships with third-party providers that aren't in your best financial interest. And now for the section that can save you a fortune, the one that almost no first-time homebuyer knows about. Box C. Services you can shop for. Read that again. Services you can shop for. The lender is legally required to give you a list of providers for these services, but you are under no obligation to use any of them. This is where you can take back control. What are these services? The big one is title insurance. This includes things like the title search, the title examination, and the lender's title insurance policy. The fee for this can be hundreds, sometimes thousands of dollars. The lender's preferred company might be convenient, but they are often not the cheapest. You have the absolute right to call 3 or 4 other local title companies, give them your purchase price and loan amount, and ask for a quote. You can often save hundreds of dollars with just a few phone calls. Other fees in this section can include a property survey fee and a pest inspection fee. Don't just blindly accept the provider your lender, or even your real estate agent suggests. Do your own homework. You are the CEO of your home purchase, you have to sign off on all the vendors. So let's replay the scenario with Mark and Sarah. This time they're armed with question 5. They go to lender A, who offers that beautiful low interest rate. They say, "Great, thank you. Before we proceed, please send over the official loan estimate." They do the same with lender B and lender C. When the documents arrive, they ignore the interest rate for a moment and go straight to page 2. They see that lender A, the one with the low rate, has $4,500 in origination charges in box A. It's packed with fees: an application fee, a processing fee, an underwriting fee, and a loan administration fee. It's a junk fee buffet. Then they look at lender B's loan estimate. Lender B's interest rate is 1/8 of a point higher, but their origination charges in box A? Only $1,500. A single, simple origination fee. That's a $3,000 difference right there. They also notice lender A's appraisal fee in box B is $200 higher than lender B's. And the title services in box C are $400 more expensive. When they add it all up, even though lender B has a slightly higher interest rate, their total closing costs are nearly $4,000 less than lender A's. Over the life of the loan, the slightly higher rate might cost them a little more, but in terms of the immediate out-of-pocket cash they need to close, lender B is the clear winner. They avoid the panic, they avoid draining their savings, and they walk into their closing feeling confident and in control. They didn't get suckered by the shiny object of the lowest rate. They understood the total cost of the transaction. This is the power of question 5. It's not just about asking for a document. It's about understanding it. It's about knowing where to look for the hidden costs and the padded fees. It's about knowing which costs are fixed, which are negotiable, and which ones you can source yourself to save money. Asking this question and comparing those loan estimates line by line is the single most effective thing you can do to protect yourself from last-minute surprises and ensure you're getting a truly competitive deal, not just a flashy headline rate. You now have the 5 essential questions. You know how to vet a loan officer, how to understand the timing of your rate lock, how to plan for the worst-case appraisal scenario, and now how to dissect the fee structure of the loan itself. You are more prepared than 95% of homebuyers out there. But having the questions is only half the battle. The other half is knowing how to strategically use the answers to make lenders compete for your business. It's about turning their own information into your leverage. In our final part, we will move from questions to action. I'm going to give you the simple 2-sentence negotiation script that can save you thousands and reveal the one final document you absolutely must review 24 hours before closing to ensure you weren't the victim of a last-minute bait and switch. This is how you close the deal like a pro. Okay, you have your offers in hand. You've narrowed it down to your top 2 lenders. Now it's time to negotiate, and most people skip this step because they're afraid. They think the numbers are set in stone. They are not. But you can't just say, "Can you do better?" You need a strategy. Here is the exact script. First, call the lender you like slightly less. Let's call them lender B. You'll say something like, "Hi, loan officer's name. It's your name. Thanks again for sending over the loan estimate. We're making our final decision today, and we have a competing offer that's come in with slightly lower lender fees. We'd really love to work with you if you have any flexibility to reduce the origination or underwriting fee to be more competitive. Is there anything you can do?" Be polite, be direct. They might say yes, they might say no. It doesn't matter. Their answer is just information. If they say yes and lower their fees, great. You now have a new lower baseline. If they say no, that's also fine. You still have your original offer from lender A. Now you call your preferred lender, lender A. This is the one you actually want to work with. The script is almost identical, but with more warmth. "Hi, a loan officer's name. It's your name. We've reviewed all our options and we were so impressed with your team. We'd really love to move forward with you. We're ready to lock in our rate today. The only thing holding us back is that we have another official loan estimate that has come in with lower closing costs. Specifically, their underwriting fee is about $300 less. Is there any way you can match that for us? If you can, we're ready to sign." See the difference? You complimented them. You created a sense of urgency. We're ready to lock in today. You gave them a specific, reasonable number to match, not a vague request. You made it easy for them to say yes. A loan officer can often get a small fee reduction approved to win the business. It's a tiny amount for the bank, but for you, saving $300, $400, even $500 on fees is a huge win. It's a steak dinner, it's a new lawnmower. It's money that stays in your pocket, all from one 5-minute phone call. Now, for the 5th and final question. This is the one that separates the amateurs from the pros. It's the question that 99% of buyers never think to ask, and it can save you from a catastrophic last-minute denial. You've got your best offer, you're feeling good, and you ask your loan officer this. What are your lender-specific overlays on top of the standard agency guidelines? You might hear a pause on the other end of the phone. This question signals that you are a serious, educated borrower. Let me break down what it means. Most mortgages in the U.S. are eventually sold to two giant government-sponsored enterprises, Fannie Mae and Freddie Mac. These agencies set the baseline rules for what makes a qualified mortgage. They'll say a borrower needs a minimum credit score of, say, 620, and a maximum debt-to-income ratio of, say, 45%. Those are the agency guidelines. But here's the secret. Individual lenders, the banks, the credit unions, are allowed to add their own stricter rules on top of that baseline. These extra rules are called overlays. It's like a recipe. Fannie Mae provides the basic recipe for chocolate chip cookies. It says you need flour, sugar, and chocolate chips. But lender A might look at that recipe and say, you know what, for our cookies, we're also going to require premium vanilla extract, and we won't accept any cookies baked for less than 12 minutes. That's an overlay. Lender B might say, our cookies require brown sugar instead of white sugar, and we mandate a higher percentage of chocolate chips. That's their overlay. Both are still making chocolate chip cookies that follow the base recipe, but they have their own internal stricter standards. So, Fannie Mae might say a 620 credit score is acceptable, but your lender might have an overlay requiring a 660 score. The government guideline might allow for a gift to be used for a down payment, but a specific lender might have an overlay that says that gift can only come from an immediate family member and requires 3 months of their bank statements as proof. Why does this matter so much? Because you could be a perfectly qualified borrower according to the official government guidelines, but get denied by a particular lender because you don't meet their secret, internal overlays. You might get pre-approved, spend weeks looking for a house, get an offer accepted, pay for an inspection and an appraisal, only to have the underwriter deny your loan at the last second because of an overlay you never even knew existed. It is heartbreaking, and it happens all the time. By asking, what are your overlays? You are forcing transparency. A good loan officer will be able to say, that's a great question. Our main overlays are that we require a 640 minimum credit score instead of 620, and for self-employed borrowers, we require a full 2 years of tax returns, no exceptions. Now you know the real rules of the game you're playing. If you're a self-employed borrower with only 1 year of returns, you know this lender isn't for you. And you've just saved yourself a month of wasted time and thousands in lost fees. This question uncovers the hidden tripwires before you step on them. Okay, you've asked the questions. You've negotiated the fees. You've been approved by underwriting. You're in the home stretch. The finish line is in sight. But this is where the most costly mistakes are made. This brings us to the final critical piece of the puzzle I promised. The one document you must review to protect yourself from a bait and switch. By law, at least 3 business days before your scheduled closing date, your lender must provide you with a document called the Closing Disclosure, or CD. Think of this as the final bill for your mortgage. It is a 5-page document that details the exact, final terms of your loan and all the costs involved. That 3-day window is not a suggestion. It's a legally mandated cooling-off period designed to protect you. You need to use every second of it. The moment that closing disclosure hits your inbox, drop everything. Do not assume it's correct. Do not just glance at it. You are going to compare it line by line against your most recent loan estimate. You're looking for discrepancies. First, check the big stuff at the top of page 1. Is your name spelled correctly? Is the property address perfect? Is the loan term what you agreed to, 30 years, 15 years? Is the loan type correct, conventional FHA, VA? And most importantly, is the interest rate the exact percentage you locked in? A simple typo here could cost you tens of thousands of dollars over the life of the loan. Second, flip to the closing cost details. Compare the lender fees, the origination, underwriting, and processing fees, to what was on your loan estimate. Have any of them changed? Did a new mysterious administrative fee suddenly appear? This is where junk fees can be slipped in at the last minute, hoping you won't notice. Question every single change. Third, look at your monthly payment breakdown. Principal and interest, homeowner's insurance, property taxes, and mortgage insurance, if you have it. Does that total pity payment match what you were expecting? Sometimes the estimates for taxes and insurance can change once the final numbers come in. So a small variation is normal. But if it's a significant jump, you need to ask why right now. Finally, look at the bottom line, the cash to close figure. This is the exact dollar amount you need to have as a cashier's check or wire transfer on closing day. Does this number make sense to you? Does it reflect your down payment and the closing costs you've been discussing all along? If you find a discrepancy, any discrepancy, no matter how small, you must contact your loan officer and your closing agent or attorney immediately. Do not be shy. Do not feel like you're being a nuisance. This is your money and your future. A simple mistake could be a typo. A significant change could be a bait and switch. That 3-day window is your last chance to get it fixed without delaying your closing. This entire process, from the first question to this final review, is about shifting the power dynamic. It's about walking into the biggest financial transaction of your life not with fear and confusion, but with clarity and confidence. You are no longer just a passive applicant. You are the informed driver of the entire deal. You know the right questions to ask, you know how to negotiate, and you know how to audit the final numbers to protect your interests. You've done the work. You've educated yourself. And now you're ready to walk into that closing, sign those papers, and accept the keys to your new home, knowing you secured the absolute best deal possible. If this series has helped you feel more prepared for that journey, do me a favor and share it with just one friend or family member who's about to start this process. And let me know in the comments which of these questions was your biggest aha moment. Thank you for investing this time in yourself. Now go make it happen. You've got this.